Your 401k balance looks good right now. Maybe it hit a new high this month. Maybe you are finally on track for the retirement you planned. Maybe you checked the app last week and felt relief. But here is what nobody is telling you. If the stock market crashes in 2026, and all the indicators say it will, you could lose 40 to 50% of your retirement savings in less than a year, and it will not come back for a decade. That is not a prediction. That is what happened in 2008. The S&P 500 crashed 57%. Retirement accounts lost $2.4 trillion. Millions of people who were months away from retiring had to work 5 more years, 10 more years. Some never retired at all. And right now, in early 2026, every warning sign that preceded the 2008 crash is flashing red. Yield curve inverted for 22 months. Consumer debt at all-time highs. Commercial real estate collapsing. Federal deficits exploding. AI stock bubble at .com valuations. But your 401k statement does not show any of this. It shows your balance, and your balance looks fine. So you assume everything is fine until the day it is not. And on that day, when the market opens down 5% and keeps falling, you will have minutes to decide. Do you sell and lock in losses? Do you hold and watch it drop further? Do you panic, or do you have a plan? Most people have no plan. They have never thought about what happens to their 401k in a crash. They have been told to buy and hold, to stay the course, to trust the long term. And all of that advice works until it does not. Until you are 62 years old and planning to retire at 65 and your account just lost half its value. Then staying the course means working until 70 and hoping the market recovers before you die. Before we show you exactly what happens to your 401k if the market crashes in 2026, how the mechanics work, who gets hurt the most, and what you can do right now to protect yourself, hit that subscribe button and join the Wealth Forum. We break down the retirement crises before they destroy your future. Turn on notifications, because what happens in the next 10 minutes could determine whether you retire on time or work until you drop. Now let's talk about what actually happens when the market crashes and why your 401k is more vulnerable than you think. Let's go back to October 2007. The market was at all-time highs. The S&P 500 hit 1565. Unemployment was 4.7%. The economy looked strong, and millions of Americans had their entire retirement savings in 401k accounts invested in stock funds. They had been told this was safe, diversified, long-term, and for 20 years, it had worked. The market went up. Balances grew. Retirement looked secure. Then 2008 happened. In March, Bear Stearns collapsed. In September, Lehman Brothers failed. The stock market went into freefall. By March 2009, the S&P 500 hit 676, down 57% from the peak. If you have $500,000 in your 401k in October 2007, you had $215,000 in March 2009. You lost 285, more than half your retirement, gone in 17 months. And it took until 2013 for the market to fully recover. 5 years. If you were 60 in 2008, planning to retire at 62, you could not. Your account was destroyed. You had to keep working and hope you lived long enough to see it come back. But here is what most people do not understand. The crash did not hurt everyone equally. It hurt people near retirement the most. If you were 30 in 2008, with $50,000 in your 401k, you had 35 years to recover. The crash was painful but survivable. You kept contributing. You bought stocks at low prices. And by 2024, your account was bigger than ever. But if you were 60 in 2008, with $500,000 in your 401k, you did not have 35 years. You had 5 years, maybe 10, and losing 57% of your account with 5 years. Until retirement is catastrophic, because you cannot just keep contributing. You are supposed to be withdrawing. And you cannot buy at low prices when you are selling to live. This is the fundamental problem with 401ks. They are designed for people with time. They work great if you have 30 years until retirement. They work terribly if you have 5 years. Because the market does not care about your timeline. It crashes when it crashes. And if you are unlucky enough to be near retirement when that happens, you are destroyed. Here is the analogy. Imagine you are flying across the country. If the plane hits turbulence when you are halfway there, it is uncomfortable but survivable. You have time to stabilize. But if the plane hits turbulence 10 minutes before landing, when you are descending and low on fuel, you could crash. Your 401k is the same. If the market crashes when you are halfway to retirement, you recover. But if it crashes 10 minutes before you land, you are in serious trouble. Now let's talk about the mechanics. How does a market crash actually destroy your 401k? And why is it worse than you think? Here is how your 401k works. You contribute money every paycheck. That money goes into funds, usually stock funds, index funds, target date funds. Those funds buy shares of companies, Apple, Microsoft, Nvidia, Amazon. When those stocks go up, your balance goes up. When they go down, your balance goes down. You do not own the stocks directly. You own shares of a fund that owns the stocks. And that is where the first problem starts. When the market crashes, fund values collapse, not because the companies disappear, but because everyone is selling at the same time. Think of it like this. You own a house worth $500,000, but one day, everyone in your neighborhood tries to sell at once. There are 100 houses for sale and 5 buyers. What happens? Prices collapse. Your house that was worth $500,000 is now worth $250,000, not because the house changed, but because the market changed. The same thing happens with stocks. When everyone sells, prices collapse, and your 401k balance collapses with it. But here is the second problem. You cannot get your money out quickly. 401k accounts are not like bank accounts. You cannot just transfer the money and walk away. If you try to sell in a panic, you have to request a distribution. That takes days, sometimes weeks, and while you are waiting, the market keeps falling. By the time your distribution processes, your account is down another 10%. This is called liquidity risk, and most people never think about it until it is too late. The third problem is forced selling. Here is how this works. Imagine you are 65, you just retired. Your 401k has $800,000. You plan to withdraw 4% per year. That is $32,000, enough to live on with Social Security. But 6 months after you retire, the market crashes 50%. Your account drops to $400,000. Now you have a problem. You still need $32,000 to live. But that is 8% of your account, not 4%. And if you withdraw 8% per year, you will run out of money in 12 years. So you have two choices. Cut your spending in half and live on $16,000, or keep withdrawing and hope the market recovers before you go broke. This is called sequence of returns risk, and it is the biggest danger to retirees. If the market crashes early in your retirement, you are forced to sell shares at the worst possible time. You lock in losses, you deplete your account, and you might never recover. Even if the market comes back, because you sold at the bottom to pay for groceries. The fourth problem is the concentration risk. Right now, the S&P 500 is dominated by 7 stocks. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. These 7 companies represent 30% of the index. If you own an S&P 500 fund in your 401k, you are massively concentrated in 7 tech stocks trading at bubble valuations. If those stocks crash, your 401k crashes, even if the other 493 companies are fine. This is what happened in 2000. The Nasdaq crashed 78%. Tech-heavy 401ks were wiped out, and it took 15 years to recover. The fifth problem is the fee drag. Your 401k charges fees, management fees, expense ratios, administrative fees. They seem small, maybe 0.5%, maybe 1%. But in a crash, those fees become devastating. Here is why. If your account drops 50% and you are paying 1% in fees, you are paying 1% on a smaller balance, but you are also paying fees while the market is down. So you are losing money to fees and to the market. And those fees compound over time. A 1% fee over 30 years costs you 30% of your final balance. But in a crash followed by a slow recovery, it could cost you 40%, because you are paying fees on money that never comes back. These 5 mechanisms work together. Fund values collapse. Liquidity disappears. You are forced to sell at the bottom. Concentration risk amplifies losses. And fees drain your account while you wait for recovery. This is how a market crash destroys 401ks. And this is why people near retirement are the most vulnerable, because they do not have time to wait it out. Now let me show you what a 2026 crash would actually look like. And who gets destroyed? Here is the scenario. The S&P 500 is at 6,200. Your 401k is at an all-time high. You are 63 years old. You have $850,000 in your account. You plan to retire at 65. Everything is on track. Then something breaks. Maybe it is a failed treasury auction. Maybe it is a major bank failure. Maybe it is a geopolitical crisis. Does not matter what starts it. What matters is what happens next. The market opens down 5%, then 7%, then 10%. Circuit breakers trigger. Trading halts. The news is calling it a crash. You check your 401k app. Your balance is down $85,000 in one day. Your heart is racing. Your hands are shaking. And you have to decide. Do you sell now? Do you hold and hope it recovers? You call your financial advisor. They tell you to stay calm. This is normal volatility. The market always recovers. Do not panic. But the next day, the market is down another 8%. Your account is now down $150,000. You have lost 2 years of salary in 2 days. And it keeps falling for weeks, then months. By October 2026, the S&P 500 is down 45%. Your $850,000 account is now worth $467,500. You have lost $382. $500, almost half your retirement, and you are 2 years away from retiring. Now what? Your plan was to retire at 65 with $850,000. Withdraw 4% per year. Live on $34,000 plus Social Security. But with $467,500, 4% is only $18,700. You cannot live on that. So your choices are brutal. Option 1, keep working. Delay retirement 5 years. Hope the market recovers and your account gets back to $850,000 by the time you are 70. But you are not guaranteed to live to 70. And 5 more years of work was not the plan. Option 2, retire anyway. Live on less. Cut your expenses in half. Spend $18,700 plus Social Security. But that means no travel, no hobbies, no helping your grandkids, just surviving. Option 3, withdraw more than 4%. Take out $34,000 anyway. But that is 7.3% of your account. And at that rate, you run out of money in 14 years. If you live to 79, you are broke. Those are your options. And millions of Americans will face those exact choices if the market crashes in 2026. Because right now, there are 60 million people with 401k accounts. And 10 million of them are between ages 60 and 70, planning to retire in the next 5 years. With an average balance of $250,000, if the market crashes 45%, those accounts drop to $137,500 and retirement plans collapse. But here is the cruel twist. The crash does not affect everyone the same way. If you are 35 with $100,000, in your 401k and the market crashes 45%, your account drops to $55,000. That hurts, but you have 30 years to recover. You keep contributing. You buy shares at low prices. And by the time you retire at 65, the crash is a distant memory. You might even be glad it happened because you bought stocks cheap. But if you are 63 with $850,000 and the market crashes 45%, you do not recover. You do not have 30 years. You have 2 years. And those 2 years determine whether you retire or keep working. Whether you live the retirement you planned or the retirement you can afford. Difference between freedom and desperation. This is the fundamental injustice of 401ks. They socialize the risk. Everyone is in the same funds. Everyone rides the same market, but the consequences are not equal. Young people recover. Old people do not, and the system does not care. Because the system is not designed to protect people near retirement. It is designed to protect the market. And the market does not care about your timeline. Now let me show you what happens after the crash and why the recovery might not save you. Here is what happens in the aftermath. The market crashes 45%, your account is cut in half, and now you wait, because you have been told the market always recovers. And it does. Eventually. But eventually might be 5 years. It might be 10 years, and you might not have 10 years. Let's say the crash happens in 2026, and the market hits bottom in 2027, then it starts recovering, slowly, 10% a year. By 2030, the market is back to where it was in 2024. But that is 6 years of recovery. If you are 63 in 2026 and you wait 6 years, you are 69 before your account is whole again. You have missed your entire retirement window. You work through your 60s, waiting for the market to come back. And by the time it does, you are almost 70. Was it worth it? Was waiting for recovery worth losing your 60s? But here is the worst scenario. What if you could not wait? What if you retired anyway? What if you needed money to live? Then you are withdrawing from a falling account. Every month you sell shares, and those shares are worth less than they were. You are locking in losses, depleting your principal. And even when the market recovers, you have fewer shares. So your account does not fully recover. This is called the death spiral, and it kills retirement. Here is an example with numbers. You retire in 2026 with $850,000. The market crashes. Your account drops to $467,500. You withdraw. $34,000 per year to live. After 1 year, your account is $433,000, but the market recovered 10%. So your account is now $476,850. You withdrew. $34,000 again. Now you are at $442,850. The market recovered another 10%. Your account is $487,135. You see the problem. Even though the market is recovering 10% per year, your account is barely growing because you are withdrawing faster than it recovers. By year 5, the market is back to its 2026 peak, but your account is only $550,000, not $850,000, because you sold shares at the bottom and you cannot get them back. This is why sequence of returns risk is so devastating. It is not just about the crash. It is about the recovery. If you are forced to withdraw during the recovery, you miss the gains and you never catch up. This is what happened to millions of retirees in 2008. Their accounts recovered eventually, but not fully, because they sold at the bottom and time ran out. So what do? First, if you are within 5 years of retirement, you cannot afford to be 100% in stocks. You need bonds, cash, stability. The rule is simple. The closer you are to retirement, the more conservative you should be. If you are 30, be aggressive. If you are 60, be defensive. But most people do not adjust. They stay aggressive until the day they retire. And then they hope the market does not crash. That is not a plan. That is gambling. Second, build a cash buffer. If you are retiring soon, have 2 years of expenses in cash. Not in your 401k, in a savings account. That way, if the market crashes, you do not have to sell. You live off cash for 2 years while the market recovers. This breaks the death spiral. This saves your retirement. Third, consider a Roth conversion. If your 401k is traditional, you pay taxes when you withdraw. But if you convert to Roth, you pay taxes now and withdraw tax-free later. Why does this matter in a crash? Because if you convert when the market is down, you pay taxes on a lower balance. Then when it recovers, all the gains are tax-free. This is how you turn a crash into an advantage. Fourth, do not panic. Do not sell everything at the bottom. Do not lock in losses. Have a plan, stick to it, and know that crashes are temporary, but bad decisions are permanent. The people who lost the most in 2008 were not the ones who held. They were the ones who sold at the bottom and never got back in. Do not be that person. And fifth, understand this. Your 401k is not guaranteed. It is not insured. It is not protected. It is exposed to the market. And the market can take half your money in a year. If you are not prepared for that, you are not prepared for retirement. So here is the lesson. Your 401k looks safe right now, but it is not. It is exposed to a market that is showing every warning sign of an imminent crash. Yield curve inverted, debt at records, valuations at extremes. And if that crash happens in 2026, millions of people near retirement will lose half their savings. Some will recover, most will not, because they do not have time, because they will be forced to withdraw at the bottom, because sequence of returns risk will destroy their plans. And the cruelest part is this. The system will not save you. Your 401k provider does not care. Your employer does not care. The market does not care. They all benefit from you staying invested. They all want you to buy and hold because they make money on fees. They make money on volatility. They make money whether you retire or not. Your retirement is your problem, not theirs. So the question is whether you are prepared, whether you have adjusted your allocation, whether you have built a cash buffer, whether you have a plan for what you do if the market crashes next month. Because if you do not have a plan, you will panic. And panic is how retirements are destroyed. Subscribe now to The Wealth Forum for continued coverage on how to protect your retirement as the warnings. Intensify, turn on notifications. Share this with anyone near retirement who thinks their 401k is safe. But before you go, leave a comment. Tell me this. If the market crashes 50% next month, do you have a plan? Or will you panic? Because I want to know how many people are actually prepared for what is coming. Your 401k is not as safe as you think. The market crash is not as far away as you hope. And your retirement is not guaranteed. The only question is whether you will be ready.